The loss that should concern you is not always the one printed on your statement. It is the loss that teaches you the wrong lesson. You take a bad trade, survive it, recover a little, and quietly decide that your judgment was not the problem. Only your timing was. That is a dangerous kind of comfort. Before you take another loss, you must understand this. The market does not punish you only for being wrong. It punishes you for staying confused after the evidence has changed. A trade can begin with a reasonable idea and become reckless simply because you refuse to update your view. The mistake is not always entering. Often, the mistake is continuing to behave as if the original reason still exists. This is where a trader begins to separate discipline from stubbornness. Stubbornness says, "I know what this market should do." Discipline says, "I know what I will do if the market does not confirm me." That difference may sound small when you are calm, but under pressure it becomes the distance between a controlled loss and a wound that changes your next 10 decisions. Notice what happens after price moves against you. Your attention narrows. You stop reading the market and start reading your own discomfort. You look for one candle, one level, one rumor, one delayed reaction that might give you permission to hold. But the market is not interested in giving you permission. It is showing you participation, hesitation, urgency, or absence. Your task is to observe those things before your need to be right begins editing what you see. A weak trader treats a loss as an insult. A developing trader treats it as information, but even information can be misused. If you take a loss and immediately search for revenge, you have learned nothing. If you take a loss and reduce every future trade until you are afraid to act, you have also learned nothing. The useful question is quieter. What did the market show before the loss became obvious? There are signs worth studying. Did the move fail where it should have continued? Did volume appear without progress? Did a breakout attract buyers, then quickly trap them? Did you enter because the market was proving something, or because you were tired of waiting? These are not philosophical questions. They are practical ones. They determine whether your next decision is based on observation or emotion wearing the mask of analysis. So before you take another loss, do not ask only where your stop should be. Ask what behavior would prove that your idea is no longer healthy. Ask what kind of price action would tell you that better traders are no longer pressing in your direction. Ask whether you are trading the market in front of you or defending the market you expected to see. The loss that should concern you is not always the one printed on your statement. It is the loss that teaches you the wrong lesson. You take a bad trade, survive it, recover a little, and quietly decide that your judgment was not the problem, only your timing was. That is a dangerous kind of comfort. Before you take another loss, you must understand this: the market does not punish you only for being wrong. It punishes you for staying confused after the evidence has changed. A trade can begin with a reasonable idea and become reckless simply because you refuse to update your view. The mistake is not always entering. Often, the mistake is continuing to behave as if the original reason still exists. This is where a trader begins to separate discipline from stubbornness. Stubbornness says, "I know what this market should do." Discipline says, "I know what I will do if the market does not confirm me." That difference may sound small when you are calm, but under pressure it becomes the distance between a controlled loss and a wound that changes your next 10 decisions. Notice what happens after price moves against you. Your attention narrows. You stop reading the market and start reading your own discomfort. You look for one candle, one level, one rumor, one delayed reaction that might give you permission to hold. But the market is not interested in giving you permission. It is showing you participation, hesitation, urgency, or absence. Your task is to observe those things before your need to be right begins editing what you see. A weak trader treats a loss as an insult. A developing trader treats it as information. But even information can be misused. If you take a loss and immediately search for revenge, you have learned nothing. If you take a loss and reduce every future trade until you are afraid to act, you have also learned nothing. The useful question is quieter. What did the market show before the loss became obvious? There are signs worth studying. Did the move fail where it should have continued? Did volume appear without progress? Did a breakout attract buyers, then quickly trap them? Did you enter because the market was proving something, or because you were tired of waiting? These are not philosophical questions. They are practical ones. They determine whether your next decision is based on observation or emotion wearing the mask of analysis. So before you take another loss, do not ask only where your stop should be. Ask what behavior would prove that your idea is no longer healthy. Ask what kind of price action would tell you that better traders are no longer pressing in your direction. Ask whether you are trading the market in front of you or defending the market you expected to see. A trade can be right in direction and still be wrong in the way it is taken. This is one of the harder lessons because it does not flatter the trader. You may read the market well, choose the stronger side, and still walk away with a loss because your action did not match the quality of your idea. The market does not pay for opinion. It pays for correct participation. There is a difference between seeing an opportunity and entering it properly. An opportunity has conditions. It has a place where risk is clear, where participation is fresh, where the distance between entry and invalidation is still reasonable. If you arrive after that place has passed, you are no longer trading the same idea. You are paying a worse price for a cleaner feeling. This is why chasing is so costly. The move begins, the candle stretches, and suddenly the trade looks obvious. But by the time it looks obvious, the earlier buyers may already be in profit. The late buyers may be exposed, and the next pullback may be enough to force weak hands out. You may be correct that the market is strong, but if you enter where the trade no longer offers a fair risk, strength alone cannot protect you. Poor execution also hides inside hesitation. The market reaches your level, gives your condition, and you pause. You wait for one more sign, then another. By the time you act, the clean entry has become crowded. Your stop must now be wider, your target less favorable, and your emotional tolerance thinner. The delay turns a structured trade into a compromised one. This is not a small detail. Entry location shapes the entire trade. A good entry gives you room to think. A poor entry makes every normal fluctuation feel dangerous. When your price is bad, the market does not need to reverse much to put you under pressure. A trade that should have been manageable becomes difficult, not because the idea failed, but because the execution left no margin for ordinary movement. You must also respect the quality of the moment. Some prices are technically attractive but practically poor. A signal that appears in thin conditions may not have the same weight as one that forms when real participation is present. A breakout in a quiet pocket can tempt you, but without sufficient follow-through it may simply expose you. A trade placed into weak liquidity can slip, stall, or reverse before the idea has a fair chance to develop. Execution is the bridge between analysis and outcome. If that bridge is weak, the analysis cannot carry you. You may study the right levels, mark the right zone, and understand the likely direction, but none of that removes the need to act at the proper moment. The market rewards precision because precision controls the distance between being early, being timely, and being late. So you must begin to judge your trades in two parts. First was the idea sound. Second was the handling of that idea sound. Do not mix the two. A winning trade taken poorly can teach bad habits. A losing trade taken properly can still be useful. But a good idea executed badly must be named honestly, because otherwise you will blame the market for damage caused by your own timing. Before entry, look at the trade as if you have not yet earned the right to take it. Is the price still near the area where the idea makes sense? Is the risk still defined without stretching reason? Has the move already spent too much energy? Are you entering because the setup is present or because the move is leaving without you? These questions keep execution from becoming impulse with a chart attached. The serious trader does not need every move. He needs the right move at the right price under the right conditions. When those conditions are gone, discipline is not proved by forcing participation. It is proved by letting the missed trade remain missed. Because once execution becomes careless, the next problem is no longer just where you entered. It becomes how much damage that careless entry is allowed to do. One loss does not have to be large to be serious, but one large loss can make every future trade heavier. This is the part of trading that does not negotiate. The account does not care how confident you were, how close the trade came to working, or how strong the idea appeared. It only records the damage. A trader who loses 1% has a simple task ahead. A trader who loses 10% has a harder task. A trader who loses 30% is no longer playing the same game. The larger the drawdown, the greater the return required just to return to where you started. Lose 10%, and you need more than 10% to recover. Lose 50%, and you need a full 100% gain just to get back to even. This is why the size of a loss matters more than the emotion around it. A small loss preserves freedom. A large loss removes options. When your capital is intact, you can wait, choose, reduce, study, and continue. When your capital is wounded, every decision becomes pressured by the need to repair. The mathematics creates the pressure before the mind even begins to respond. Trading is not decided by one trade. It is decided by the sequence. A system with an edge still contains losing trades. A skilled trader still has periods where the market gives nothing easily. If your risk is too large, a normal losing sequence becomes an account event. What should have been ordinary variance becomes damage that changes the future. This is where traders misunderstand probability. They accept that losses will happen, but they size positions as if losses will arrive politely, one at a time with recovery in between. Markets do not offer that courtesy. Losses can come in clusters. A method can go cold. Conditions can shift. Your job is not to predict the exact order of wins and losses. Your job is to make sure the order cannot destroy you. Expectancy only has meaning if you survive long enough for it to work. A trader may have a positive method, but if he risks too much on each attempt, the mathematics can ruin him before the edge has time to express itself. This is a hard truth. Being right over time does not protect you from being oversized today. A good method placed under reckless risk becomes fragile. Think of every trade as a cost of participation. You are not paying to be certain. You are paying for exposure to an opportunity. If the cost is small and controlled, you can take many attempts without losing your place. If the cost is too large, the trade stops being one attempt among many and becomes a demand that the market cooperate immediately. That demand is dangerous because the market is never obligated to arrange itself around your account. The practical question is not, how much can I make if this works? That question tempts the trader to measure upside before respecting survival. The better question is, what happens to my next 10 trades if this one fails? If one loss damages your ability to take the next valid trade, then the position is too large. If one loss forces you to abandon your plan, trade smaller. If one loss makes recovery mathematically steep, the trade has already taken more authority than it deserves. You must learn to respect the quiet arithmetic before the loud result. A controlled loss keeps the sequence alive. An oversized loss breaks the sequence and forces you into a different contest. One where you are no longer trading for growth, but fighting to repair damage. That is a poor position from which to make clear decisions. So before you take another loss, measure not only the trade in front of you, but the path it leaves behind. The serious trader does not fear losing. He fears allowing one loss to become large enough to distort the next decision, the next week, and the next opportunity. Because once the mathematics is protected, the next question becomes clearer. What exactly is the market showing when a trade begins to fail? When a trade starts to fail, the first thing to remember is the market is not moving against you. It is moving because orders are changing hands in a way your original idea did not account for. That distinction matters. If you see the movement as opposition, you become concerned with yourself. If you see it as information, you can study what has changed. Price is not merely a line on a chart. It is the record of agreement and disagreement between buyers and sellers. When price rises easily, buyers are not just present, they are willing to keep paying higher prices. When price falls without much resistance, sellers are not just active, buyers are stepping away. A trade begins to weaken when the side you expected to dominate no longer advances with the force it should. This often appears before the loss is obvious. A breakout clears a level, but does not travel. A pullback holds for a moment, but the next push lacks urgency. A market reaches new highs, yet each advance becomes shorter and heavier. These are not random details. They are signs that participation is changing. The trader who notices them early is not predicting the future. He is reading the present more honestly. A failed breakout is one of the clearest lessons. Price moves through a level that should attract fresh buying, but instead of expanding, it stalls. Those who bought the breakout are now exposed. If price returns back inside the old range, the breakout no longer represents strength. It begins to represent trapped commitment. The same movement that looked bullish a few moments earlier can become fuel for selling, because late buyers must now decide whether to exit. Absorption teaches another lesson. You may see strong buying, heavy volume, and repeated attempts to lift price, yet the market barely moves higher. That means supply is meeting demand. The visible effort is not producing progress. When effort fails to move price, a trader must ask whether the stronger side is truly strong, or whether it is spending itself against hidden resistance. The market often weakens not after buyers disappear, but after buyers exhaust themselves without result. There is also the sweep. Price runs above a high or below a low, triggers orders, draws in late participation, and then turns back. To the untrained eye, this looks like confusion, but often it is the market searching for liquidity. Stops are triggered. Breakout traders enter. The book changes. If price cannot hold beyond that area, the move may have served its purpose already. It collected orders, not direction. Trend exhaustion is quieter. In a healthy trend, reactions are absorbed and continuation comes with authority. In a tiring trend, progress becomes labored. Pushes still occur, but they require more effort and produce less distance. Pullbacks begin to travel farther. Time spent near the highs or lows becomes unstable. The market may still look alive, but its behavior has changed from expansion to maintenance. You must learn to separate movement from quality of movement. A candle can be large and still be poor if it appears late and receives no continuation. A level can break and still fail if the market does not accept price beyond it. A pullback can look harmless until the recovery attempt becomes weak. The question is not only, did price move? The better question is, did the right participants respond the way they should have responded? This keeps you from treating every adverse move as noise and every favorable move as confirmation. The market has character in each phase. Strong markets reject weakness quickly. Weak markets fail to respond to strength. Balanced markets punish impatience from both sides. If you do not identify the behavior of the environment, you will expect one type of follow through from a market built to deliver another. So before you take another loss, stop asking whether the market should respect your level. Ask whether participants are still behaving in a way that supports your idea. Is pressure expanding or fading? Is price being accepted or rejected? Are traders becoming trapped or being rewarded? These observations do not remove uncertainty, but they sharpen your reading of what is actually happening. And once you can see that a failing trade is not an insult, but a change in market behavior, the next responsibility becomes unavoidable, deciding what you will do before that behavior forces the decision upon you. The worst decision in a trade is often made too late, not because the trader lacks intelligence, but because he waits until the market has already placed him under pressure before deciding what matters. By then, the decision is no longer clean. It is mixed with money, speed, frustration, and the need to make the discomfort stop. A clear decision has to be made before the position has power over you. Once you are in the trade, every movement carries weight. A candle is no longer just information. A pause is no longer just a pause. A small pullback can feel larger than it is because your capital is attached to it. That attachment does not make you weak. It simply means you are human. But because it is human, it must be accounted for in advance. This is why a trader must know what he is going to judge before the judgment is needed. If you enter without defining what confirms the trade, what weakens it, and what makes it invalid, then you have left those decisions for the most expensive moment. You will be trying to build rules while the market is moving, and the market rarely gives a troubled mind enough time to become orderly. Prediction is not the same as preparation. Prediction says, "This is what I think will happen." Preparation says, "If this happens, I will respond this way. If that happens, I will not argue with it." The first gives you direction. The second gives you control. Direction without response is incomplete because the market can change faster than your opinion. You do not need to know the future to make a good decision. You need to know the conditions under which your idea deserves continued trust. That is a different skill. A trade idea is not a permanent belief. It is a working judgment based on certain conditions. When those conditions are present, the idea has life. When they are absent, the idea must lose authority. This is where many losses become larger than they needed to be. The trader enters with a view, but no decision map. He knows what he wants the market to do, but not what he will do if the market refuses. So every new movement requires a fresh debate. Should I hold? Should I exit? Should I wait? Should I give it more room? The problem is not the questions themselves. The problem is that they arrive when the trader is least able to answer them clearly. A serious trader reduces the number of live decisions. He does not remove uncertainty, but he removes unnecessary negotiation. Before the trade, he defines the evidence that matters. He knows what would show strength, what would show failure, and what would show that nothing meaningful has happened yet. This prevents him from treating every tick as a new command. There is great value in saying, "Before entry." This is the reason for the trade, and this is what would prove that reason is no longer good. That statement forces honesty. It prevents the trade from becoming a moving argument. If the reason changes after entry, the decision must also change. If the reason remains intact, the trader can avoid being shaken by ordinary movement. Either way, the decision is tied to evidence, not impulse. You must also decide what does not matter. Not every movement deserves attention. Not every opinion deserves entry into your mind. Not every moment of discomfort is a signal. A trader who has not decided what to ignore will eventually be ruled by noise. And noise is dangerous because it creates action without meaning. Before you take another loss, ask yourself whether the next decision has already been made clearly enough. Not the outcome. The decision. What will you do if the trade proves itself? What will you do if it fails to prove itself? What will you refuse to do no matter how persuasive the moment feels? These answers must exist before pressure arrives, because pressure does not create discipline. It reveals whether discipline was prepared, and that preparation does not begin with the click of the order button. It begins earlier, in the condition of the trader before the session even starts, before the first setup appears, before the market has a chance to test whether there is structure behind his confidence. A loss often begins before the market opens, long before there is an entry, a stop, or a position to defend. It begins in the loose hour before the session, when the trader arrives without structure and mistakes casual attention for readiness. The market may not have done anything yet, but the conditions for poor trading have already been prepared. A professional trader does not depend on surprise to become alert. He prepares his mind before the market demands it. He knows what instruments deserve attention, what areas matter, what conditions would make the session worth trading, and what conditions would make restraint the better course. Without that preparation, the first strong movement can easily become a command rather than information. This is where routine earns its value. Routine is not decoration. It is the process of reducing avoidable confusion. When you begin the day with no plan, every price movement competes for your attention. A stock running early, a currency breaking a level, an index moving sharply. Each one can pull you into reaction. But when you have already mapped the field, movement is judged against preparation, not emotion. A watch list is not a list of symbols you hope will move. It is a filter against distraction. It tells you where your attention belongs and where it does not. If you trade whatever is loudest, you become a servant of noise. If you prepare only the instruments with clear conditions, you preserve judgment. The difference is not small. One trader scans for excitement. The other waits for alignment. Scenario planning gives the session its boundaries. Before the market begins, ask what would make the day bullish, bearish, or difficult. Ask where price would need to trade to prove interest is present. Ask where the market would become too mixed to trust. This is not prediction. It is preparation for several possible realities. When one of them appears, you are not surprised into action. You recognize a condition you have already considered. The professional habit of review is just as important. A trader who does not review yesterday brings yesterday forward without knowing it. If you were impatient, that impatience may still be close. If you overtraded, the urge to recover may still be active. If you missed a move, the desire not to miss the next one may be waiting quietly. The market has not opened, but your recent behavior is already present in the room. This is why records matter. Not because a journal makes a trader serious by appearance, but because memory is too selective to be trusted alone. You will remember the clean wins more easily than the sloppy ones. You will remember the market's unfairness more clearly than your lack of preparation. A written record interrupts that comfort. It shows patterns the mind prefers to excuse. You should know, before the session starts, what kind of trader you have been lately. Have your best trades come from patience or speed? Have your worst losses come from boredom, late entry, or ignoring your own levels? Are you trading better after a quiet start or after immediate action? These observations do not tell you the future, but they tell you what risks you bring into the day. Preparation also includes knowing when not to press. Some sessions deserve smaller attention. Some conditions do not match your method. Some days begin with uncertainty so thick that forcing clarity becomes expensive. A professional routine gives you permission to stand aside because it defines what quality looks like in advance. Without that definition, inactivity can feel like failure. So before you take another loss, examine the trader who arrived before the trade. Did he prepare the field, or did he simply open the screen? Did he know what mattered? Or did he wait for the market to decide for him? Did he review his recent behavior, or did he assume today would be different because he wished it to be? The market exposes preparation quickly. It does not wait for a trader to become organized after the bell. It rewards those who come with structure and tests those who come with appetite. And once the trade is finally entered, that preparation must face its next examination, what the trader does in the uncertain middle, when the position is alive but the outcome is still undecided. The middle of a trade is where good intentions are tested. Entry is finished. The result is not yet known, and the market begins to move in its own time. This is the part that exposes whether you are managing a position or merely reacting to every movement it makes. A trade is not healthy simply because it is in profit, and it is not unhealthy simply because it pulls back. The market breathes. It advances, pauses, tests, rejects, and resumes. If you treat every pause as danger, you will cut strong trades too early. If you treat every warning as normal movement, you will let weak trades become costly. The skill is in knowing what kind of movement belongs to the trade and what kind of movement changes its character. After entry, the first task is to observe whether the trade is behaving within the reason it was taken. If the idea requires acceptance above a level, then holding that area matters. If the idea depends on momentum, then stalled movement carries weight. If the idea depends on a reversal, then follow, through should appear without too much delay. Each trade has a certain behavior it must show. Management begins by comparing the live trade to that behavior. This prevents unnecessary interference. Many traders damage positions not because the market failed, but because they could not leave a valid trade alone. They enter well, then begin adjusting for no clear reason. They take profit too soon because the first gain feels pleasant. They tighten risk so aggressively that ordinary movement removes them before the idea has developed. In trying to remove uncertainty, they remove the trade's ability to work. But patience is not the same as passivity. A trade that is alive should be given room. A trade that is losing its reason should not be given excuses. If price moves against you but the structure of the idea remains intact, there may be nothing to do. If price moves favorably but fails to hold the areas it should now respect, there may be information there. Good management is neither constant action nor blind stillness. It is measured response. The same principle applies to adding size. Pressing a trade is not a reward for being right. It is a new decision requiring fresh justification. If the market confirms the original idea with strength, structure, and renewed participation, adding may be reasonable. If you add only because the position is green and confidence has risen, you are no longer managing the trade. You are increasing exposure because the market has made you comfortable. Protecting gains also requires care. A profit that is allowed to turn into a loss can damage discipline, but a profit protected too tightly can starve a good trade. The question is not whether you should protect money. The question is whether your protection respects the behavior of the market. If you move too close, you invite normal fluctuation to end the trade. If you never adjust, you may give back more than the trade's condition justifies. You must learn to read the trade in stages. Early in the position, the question is whether the idea is being accepted. In the middle, the question is whether progress is developing with enough quality. Later, the question is whether the trade still deserves room or has begun to lose force. Each stage requires different attention.